Understanding stock price movements is crucial for anyone involved in the business world. This can be achieved through two main methods: technical analysis and fundamental analysis. Technical analysis focuses on studying past market data, primarily price and volume, to forecast future price movements. It uses charts and other tools to identify patterns and trends that can suggest future activity. On the other hand, fundamental analysis looks at economic and financial factors that influence a business. This includes the overall economy, industry conditions, and the financial condition and management of the company itself. By analyzing these elements, investors can determine a stock's intrinsic value and make informed decisions about buying or selling stocks. Combining both methods can provide a more comprehensive understanding of market dynamics and enhance investment strategies.
Investing is a crucial aspect of business expansion. It involves allocating resources, often financial, in the hope of generating future profit. There are several investment strategies that businesses can adopt, each with its unique approach and benefits. Growth investing focuses on acquiring stocks in companies whose earnings are expected to increase at an above-average rate compared to their industry or the overall market. This strategy is attractive for businesses looking to capitalize on potential high returns. Value investing, on the other hand, involves selecting stocks that appear underpriced relative to their intrinsic value. This method requires thorough analysis to identify companies trading for less than they are worth. Lastly, index investing involves purchasing a portfolio of stocks that represents a market index, aiming to mirror the performance of the index itself. This strategy is favored for its diversification benefits and lower risk. Understanding these strategies can help businesses make informed decisions to foster growth and ensure long-term success. Understanding the economics of business is crucial for making informed decisions that drive company success. One key aspect is revenue analysis, which involves examining the income generated from business activities. This helps in identifying profitable products and market trends. Another vital area is profit margins, the difference between the cost of goods sold and the revenue earned. This metric is essential for assessing operational efficiency. Lastly, annual reports provide a comprehensive overview of a company's financial health, including assets, liabilities, and equity. These reports are invaluable for stakeholders to evaluate the company's performance and strategic direction. By mastering these elements, business professionals can enhance their strategic planning and improve their company's financial stability.
Understanding the dynamics of initial public offerings, IPOs, pricing strategies, and investor engagement is crucial for any business aiming to thrive in competitive markets. An IPO marks a company's transition from private to public, allowing it to raise capital by selling shares to the public. This process requires careful planning and an understanding of market conditions to set the right price for shares. Pricing strategies, whether for products or shares, must consider both market demand and competitive positioning. Engaging effectively with investors involves transparent communication and building trust, ensuring they understand the company's value and growth potential. By mastering these elements, businesses can not only maximize their financial resources but also strengthen their market presence and investor relationships, paving the way for long-term success.
In the realm of global business, understanding currency dynamics is crucial. Exchange rates, which determine how much one currency is worth in terms of another, can be either floating or fixed. floating rates are determined by the market forces of supply and demand. Conversely, fixed rates are set by governments, pegging their currency to another major currency like the US dollar. Each system has its advantages and challenges. For businesses, fluctuating exchange rates can lead to significant financial risks. To manage these risks, companies often use strategies such as hedging, where financial instruments are used to lock in prices, or diversifying their market presence to balance potential losses. Mastering these techniques is essential for any business engaged in international trade, ensuring profitability and financial stability in a dynamic global market.
Understanding the fundamentals of portfolio management is crucial for anyone involved in business economics. This concept revolves around the strategic combination of various financial assets to maximize returns and minimize risks. Key elements include asset allocation, diversification, and risk management. Asset allocation involves deciding the mix of stocks, bonds, and other securities in your portfolio. Diversification, on the other hand, spreads investments across different assets to reduce the impact of any single asset's poor performance. Risk management is about understanding and mitigating potential losses. Effective portfolio management not only helps in achieving financial goals but also plays a vital role in the overall strategic planning of a business. By mastering these mechanics, business professionals can make informed decisions that align with their company's financial objectives.
Understanding the dynamics of interest rates and quantitative easing is crucial for anyone involved in global markets. Interest rates, set by central banks, influence the cost of borrowing money. When rates are low, borrowing is cheaper, encouraging spending and investment. Conversely, high rates can slow economic activity by making borrowing more expensive. Quantitative easing, QE, is another tool used by central banks. It involves the purchase of government securities to inject money into the economy, aiming to lower interest rates and stimulate growth. However, these policies can also lead to challenges such as inflation or asset bubbles. As a business professional, mastering these concepts helps in making informed decisions, forecasting economic trends, and understanding the broader financial landscape. This knowledge is essential for navigating the complexities of international business and finance. In the dynamic world of startups, securing the right financing is crucial for success. Seed capital, often the first type of funding a startup receives, is typically provided by angel investors or the entrepreneur's own savings. This initial investment helps to cover basic expenses and supports the business until it can generate its own cash flow. Venture capital, VC, comes into play at a later stage. VCs are professional groups that manage pooled funds from many investors to invest in startups with high growth potential. Unlike seed investors, venture capitalists not only provide larger sums of money but also bring expertise and networking opportunities to the table. Crowdfunding is another innovative funding method where entrepreneurs raise small amounts of money from a large number of people, typically via the internet. This approach not only raises funds but also tests market validation of the product or service being offered. Understanding these financing mechanisms is essential for any entrepreneur looking to navigate the complex landscape of startup funding.
Dividends are payments made by a company to its shareholders, often derived from the company's profits. Understanding dividend dynamics is crucial for investors aiming to maximize their income through high-yield investment strategies. High-yield dividends can provide a steady income stream, but they also carry risks, as companies offering high dividends might not sustain them long-term. Dividend reinvestment plans, DRIPs, allow investors to reinvest their dividends into additional shares, compounding their investment over time. This strategy is particularly effective in a growing company, as it can significantly increase the value of the investment. Interim dividends are paid before a company's annual general meeting and final financial results. They provide a regular income, which can be attractive for investors needing periodic payouts. Mastering these concepts can lead to more informed investment decisions and a robust portfolio.
Real GDP, or gross domestic product, measures the total economic output of a country, adjusted for price changes. It provides a clear picture of an economy's size and health. Growth rates, calculated from GDP, indicate how quickly an economy is expanding or contracting. A positive growth rate means the economy is growing, which is generally seen as favorable. Business cycles consist of periods of expansion and contraction in the economy. During expansion, economic activities increase, leading to higher employment and income levels. Conversely, during contraction, economic activities decrease, leading to lower employment and income levels. Understanding these indicators helps businesses and investors make informed decisions. For instance, a rising GDP might encourage companies to invest more in production capacities, while a contracting GDP might lead them to tighten budgets. By monitoring these indicators, businesses can better navigate the complexities of economic fluctuations. Understanding the stock market is crucial for anyone involved in business. The market is often measured by indexes, which are tools that track the performance of a group of stocks. These indexes, such as the Dow Jones Industrial Average or the S&P 500, provide a snapshot of market trends and help investors make informed decisions. Each index has its own method of calculation, typically involving the average price of selected stocks, which represents the overall market or specific sectors. By studying these trends, investors can predict potential market movements and adjust their investment strategies accordingly. Additionally, understanding these indexes requires knowledge of basic economic principles such as supply and demand, market sentiment, and economic indicators. Mastering these concepts will not only enhance your market insight but also equip you with the tools to excel in the dynamic world of business.
In the dynamic world of business, understanding economic conditions like inflation, deflation, and stagflation is crucial. Inflation occurs when prices of goods and services rise, reducing the purchasing power of money. This can lead to higher costs for businesses but can also drive revenue if wages and consumer spending increase. Deflation, the opposite of inflation, happens when prices decline. While consumers may benefit from lower prices, it can hurt business profits and lead to reduced investments. Stagflation is a challenging scenario where the economy experiences stagnant growth, high unemployment, and rising prices simultaneously. It poses a unique challenge as businesses must navigate slow growth while dealing with increased costs. By understanding these economic pulses, businesses can better strategize, plan for risks, and seize opportunities in a fluctuating economic landscape.